Hello, welcome to 2018. I'm talking today with Bruce Brammall, our licensed financial advisor, and we're going to talk about the main things coming into superannuation this year. Hi, Bruce.
Hi, Tony, and Happy New Year.
Yeah, Happy New Year to you. Now, there's a fair bit going on in the superannuation sector this year. I just thought we'd talk about the main things that people need to be aware of.
Yeah, well, look, a lot of the changes obviously came in on the 1st of July last year. The transfer balance cap and contribution limits, concessional, non-concessional contribution limits being dropped. What happens in the course of financial year 18, so post 30 June last year, is you'll be putting in your last tax return without the transfer balance cap in it, and making preparations for your first tax return with a transfer balance cap on it. Importantly, as part of that, and the big thing that comes about this year is either at the time that you put in your tax return for FY17 or before, you need to make the decisions that you'd want to have in regards to the CGT rollover relief. So nominate those assets on which you want the rollover relief and the assets essentially that you don't want to have rollover relief on. And once you put that in, it's final. You can't go back and change your mind. So there's going to be a lot of work needed to be done by a lot of trustees to make sure that they've put the proper thought in. Some of it's going to be a punt on future asset prices, but put enough thought into to understand, what the punts are that you're taking and what risks you're prepared to take.
Now, another thing that's coming in, I believe, this year is the 10% rule, or the old 10% rule is going or gone.
Yep.
What does that mean?
Oh, look, this is one of the best things that came out of the changes. There were, it was largely negatives, but there are a few positives. This is one of them. So the removal of the 10% rule means that you don't need to do it via salary sacrifice anymore. If you want to get extra money into super, you don't have to do it by salary sacrifice. So you're earning $100,000, your employer is putting in 9.5% of that, or $9,500. Previously, if you're an employee and earn more than 10% of your annual income from being an employee, the only way you could put extra money into super was via salary sacrifice. So they've removed that rule. Now, if you're an employee and your employer doesn't offer salary sacrifice or whatever, you just get to the end of the financial year and you're not happy, or you want to put in more than just that $9,500 that has been the SG, superannuation guarantee contributions from the employer, you can go and put in cash into the bank and get it into your super fund, bank account for a self-managed super fund, and get a tax deduction for that amount. So how's it going to work in practice? We take the same example, $100,000 with $9,500 going in under SG from the employer. You can put in up to another $15,500 straight into your super fund, lodge the notice to claim, and get a tax deduction for that $15,500 that you put in up to. So any amount that you want to. The SG contributions and what you're putting in under these new rules are still part of your $25,000 concessional contributions cap, so you need to make sure you don't go over on that. But this is a great rule. It means literally you can get round to June, middle of June or something like that, and go, oh, I sold those shares. I've got a big capital gain this year that's got to go into my tax return. How do I reduce my tax? I can make a super contribution and put in an amount up to your concessional contribution limit. So it's one of the big positives that came out of it, and that became available from the 1st of July 2017. So it's for this financial year. It's the first time it's come in.
Yeah, that's a great initiative. So for someone to actually get that tax deduction, do they get these forms from the tax office or from their super fund?
You'll get it from your super fund. So if you put the money in during a financial year, let's just say you put it in June 15th of FY18. At the end of that financial year, it'll go in as a non-concessional contribution. There will be a bit of paperwork, notice to claim paperwork essentially that you'll get from your super fund. And there are some other rules around this, and I did a column on this at the end, I think in November 2017. There are some rules around this, age-based and whatever, but you'll get that a notice to claim form, you'll fill it in, send it to your super fund. They need to get it, process it and get it off to the tax office. Now, one of the important timings on this is that this paperwork must be done before you lodge your personal tax return for that financial year. So FY18, by the 30th of June, your super fund needs to send you out the paperwork, and you need to get back this notice to claim paperwork and get it back to your super fund so they can get it to the tax office and back. And then sometime after that, you get to lodge your own personal tax return, which will have that deduction in it. So the timing of it is important.
And if you've got your own super fund, I presume the process is a little bit easier and simplified, but what needs to be done there?
Well, it's still letters that need to be lodged. Notice to claim needs to be lodged, but you're dealing with yourself, member and trustee generally, so probably with the help of your accountant or financial advisor, just to make sure that paperwork's in order and has been lodged with the tax office prior to your personal return going in.
Now, just one other thing I wanted to talk about was that from July 1 this year, we'll have these 5-year catch-up rules starting.
Yes.
Which is also another good development, I believe, anyway.
Yeah.
Let's just go over those 5-year catch-up rules.
Yeah, well, it was unfortunate because that was supposed to come in on the 1st of July 2017, but because of the argy-bargy around the concessional, some of the non-concessional and some of the other political developments, it got pushed back by a year. So what happens as of the 1st of July, you start to be able to sort of accumulate in a catch-up fashion the ability to use previous years' concessional contributions that you haven't used. So, for example, let's take our same $100,000 employee, and in FY19, which will be the next financial year, they use $9,500, just the SG contributions from the employer. In the following year, same thing again, $9,500. The third year, $9,500. The fourth year, $9,500. Salary hasn't increased. It's just $9,500 times 4 years. So they've put in $38,000 in concessional contributions. In the 5th year, it is possible, maybe a capital gain there, a pay rise, some sort of extra deduction that they might want, but they can use their $25,000 in that 5th year, not the $9,500 again, and topping up with $15,500, but they can also top up for up to the 4 previous years. So your current year plus 4 previous years to make what they call the 5-year catch-up. So in that final year, $9,500 from your employee, but you can put in potentially 5 lots of $15,000, which is $77,500, and get a tax deduction potentially for that $77,500, either via salary sacrifice, if that's the way you wanted to do it, or as we discussed earlier with the removal of the 10% rule, putting it straight into your fund and getting a tax deduction for it. The important thing is that it doesn't start to accumulate, or it doesn't kick in until the 1st of July 2018. So it won't be fully operational for 5 years after that. So it starts in 19, so that'll be the first year, FY20, FY21, FY22, in FY23 will be the first year that you'll be able to make contributions going back for those 5 years. Then FY24, that year will fall off, and the first year will fall off, and it will be this sort of 5-year revolving. Yeah.
Yeah. No, a good initiative for people to be able to get more into their super.
Certainly.
In the future.
One important rule on this one, though, is that you can only use the catch-up provisions if you have less than $500,000 in super. So there are some rules around it here. We've shortened this for this conversation, but important that, if your super balance is $600,000, then you can't use the catch-up provisions. So it's something that people with a balance of $400,000 or $450,000 and the ability in 5-6 years' time to be able to make those catch-up contributions, that they consider doing it if their balance is under $500,000.
Oh, thanks, Bruce, for coming in to talk about super today. That's been great.
My pleasure. Thanks, Tony.
Join us again next time.